senior portfolio manager at Victory Shares and Solutions. And he leverages over 31 years of active management experience to drive the growth of their rules-based and custom investment strategies. He also serves as senior portfolio manager at Newbridge Asset Management, contributing to the Newbridge large cap growth team. He's a CFA charter holder, and he holds a bachelor's in science in business management from Skidmore College and joined Victory Capital in 1999 after 6 years in investment management, including a role at U.S. Trust. I'm going to hand it over to his partner, Paul, for some other introductory remarks.
Well, thank you, everyone. It is a pleasure to be here. My name's Paul LeBlanc. I work with Victory Capital's strategic accounts team. We work with a lot of home office research and investment people at large investment platforms, broker-dealers, independent broker-dealers, as well as exclusively focused on RIA, bank trust, and family offices within my team. I cover the East Coast, and I'm thrilled to be here in Richmond today. Quick show of hands, I was just curious, anyone in the room, there's a place in town called the Secret Sandwich Society. Does anyone know of this place? Okay, yeah, thank you. All right. Well, you guys can all go there for free next time I come back in town for lunch if, we can hook up after this. But I went there yesterday and I was literally licking the plate on the way out. It was absolutely phenomenal. But I'm thrilled to be here today. How do I move this? Just like this. So I quickly wanted to introduce Victory Capital and Scott before we jump into the content today. For those of us who are not familiar with Victory Capital, we are a multi-boutique asset management firm currently managing about $181 billion in assets. As you can see by the chart on the right, it's a pretty diversified mix of assets across active equity, fixed income, non-US, alternative investment solutions, and Scott is a senior PM from our solutions business, which is one of the largest components of our AUM. Quick history about Victory Capital. The company really goes back to 2013 when we went public. As you can see, there's been a number of additions to the framework that we has it today. We are the parent company to 12 independent boutiques, and these are the shining stars kind of within our platform. Each one of these companies is an independent, standalone investment firm focused on their kind of unique aspect of investing, and then it's all kind of wrapped up into one at Victory Capital. As you can see here today, this is a quick snapshot, and this talks about the integration and the partnership that we have. So the easiest way is that I like to explain it is if there's something that we can take off the plate from the investment professionals so that it frees up their time to focus on the portfolio, their research agenda, and really to do what's best for the clients and drive performance. That's what Victory Capital is here for, and that's what we do for all of our constituents on this. And it's a pretty good partnership because you're able to get, a lot of help and support through distribution and client service, things that we do really well at Victory Capital. And the investment people, again, can really focus on their core competencies and strengths. Quick intro to the solutions team, which Scott Kefer is a senior portfolio manager of. You can see it's a little bit over $60 billion in assets, and it really runs the spectrum of investment strategies. On the left-hand side, you can see, index replication, which would be, a simple, NASDAQ 100 or S&P 500 index strategy, for example. Moving over to the, purple circles, which represent some of our ETFs. They're rules-based, quantitatively driven strategies, all the way over to the right-hand side, which is our custom solutions. But what's interesting is the green circles, and I'm going to highlight that for a minute. Not only does our solutions team manage ETF strategies, mutual funds, custom investment portfolios for other clients, they're also in the asset allocation business, and they're also doing manager search and selection. A number of the strategies that we run are open architecture, and so they sit on the same side of the table as investment allocators, really looking for the best in breed across different asset classes and styles, and what's going to help meet the goals for our portfolios. And so it's a very kind of unique aspect where they, again, have a very similar approach to many asset allocators in terms of how they do due diligence, the way that they implement strategies in their own portfolios. And it's it's a very interesting dynamic, and part of the conversation that they can bring to the table. So why are we here today? We're here today because as I sit and I talk with a lot of clients, I am constantly hearing about some similar things or some risks that are present in the market today. So quick show of hands again. I like doing surveys, keeps people awake. If anybody who's doing asset allocation or private wealth work, okay, new client walks into your office today, they're 75 and 77 years old, husband and wife, they have roughly a $3.5 to $5 million portfolio that they want you to invest for them, conservatively, a little bit income tilting. Raise your hand if you're going to structure their equity portion of their portfolio to look like the S&P 500 right now. Not one hand went up. Okay, so that's the problem. That is what we're here to talk about today, because there are some flaws right now with the current indices that a lot of people have a lot of money in. This is core S&P 500, Russell 1000 value, Russell 1000 growth. This is because of the Mag 7. And I'm not trying to scale too much of Scott's thunder, but the Mag 7, depending on what index you're looking at, represents about 35 to 40% of the index. It's almost all in information technology. That is a huge issue for a lot of clients in terms of planning for their, risk tolerance for those portfolios. The next thing that a lot of clients are looking for is ways to diversify. So knowing that there's a concentration risk out there, what am I going to do about that? And lastly, ideas looking ahead for 2025. What are the other areas we should be looking at? What are the other areas we should be considering for our portfolios? And we're here to share a little bit about that today. So without further ado, Scott Kefer.
I'm not a stand behind the podium guy. So thank you guys for having me here. It's really nice to come down and meet the CFA Society. As Paul laid out, our team, our solutions team, we're not only building solutions, individual ETFs, individual strategies. We have 20 billion of our assets are in multi-asset solutions. We're building models for our target date funds, for our target risk funds. We run a 529 plan for the state of Nevada. That requires us to figure out what asset classes to be in and how to position them. We can use our own home cooking some of our products, or we do manager selection, as Paul said. We go out and find best-of-breed third-party solutions. And navigating these markets, again, is a common challenge that we face, that we share with our clients. The concentration story is a big piece of that. I'm going to talk about a solution that I think addresses it very well. It's actually going to talk about an index that we launched that addresses this, and an ETF that we launched about a year and a half ago to track it. To put a little context around the appetite for this kind of a solution, about a year and a half ago we launched the ETF. We're at about $1.5 billion in assets, just again, 18 months out of the gate. It is tough to launch product and have success these days. It is a crowded field. If you look at the success rate of ETFs that are launched, only about 5% of ETFs can reach $1 billion in 5 years. And we've been able to do it in a year and a half. Sometimes you just build a solution that's effective, that meets the market realities, what's needed in the marketplace right now. And what we're going to talk about, free cash flow investing, is the title of this presentation said, kind of addresses the concentration risk and provides a really unique solution as we look out over the next couple of years as well. So let's talk about concentration. You guys have probably seen some stats like this, but if not, we'll just sensationalize it some more. This is a chart going back to 1964, the weight of the 5 largest holdings in the S&P 500. You can see right now we're 27%. We have not been that high since the mid-60s. In the mid-60s, it was oil companies. Now it's the Mag 7. But we're dealing with, historic levels of concentration in the index once again. It's not just the S&P, as Paul alluded to in the bottom here. NASDAQ 100, the top 5 weights, 35%. The Russell 1000 growth, 45% of the index is in 5 stocks. EM index, 20%. What we're going to look at and we're going to talk about is it's not just these growth-oriented cap-weighted indexes. It's things like quality portfolios, something that people have leaned into to diversify away from this. You'll see, as I'll show you, the top holdings there too are Mag 7. Active managers, to keep up with the benchmarks. What are they doing? Irregardless of their style and mandate, leaning into these same names. It's too hard to be naked with those stocks. The top 3, when you look at Apple, Nvidia, Microsoft, in the S&P 500, 20% of the portfolio. Again, Qual, QUAL, the MSCI Quality Index, it's supposed to be quality stocks. It too has 20% in these 3 stocks. The Russell 1000 Growth Index, 35% in these 3 stocks. And if you own XLK or one of the sector S&P tech sector ETFs, 64% of it is in these 3 stocks. This might be hard to see. Actually, a late addition to the deck here is to just show the contribution. Look, you live by the sword, you die by the sword when you have a portfolio that is that concentrated. Remember, something like the S&P 500 is intended to provide core broad market exposure. It's not really providing core broad market. When these stocks work, of course, you get a tailwind. This is from JP Morgan's Guide to the Markets. They're just going back only to 21. The Mag 7 contribution or performance up 40% in 21, down 40% in 22, 76%, 35%. The percent of contribution to return, it contributed anywhere from 30% to 63% of the return. So 7 stocks are really what matters. Again, great when they're working, like 21, like 23 and 24. Live by the sword, die by the sword in a year like 22. That same exposure works both ways. Those stocks are down 40%.
So the big question is, what might change the trajectory of those stocks going forward? This is another slide that just looks at the earnings growth of the Mag 7 in blue and the non-Mag 7 in yellow. And it goes back first quarter of 22, if you can't see it, all the way to the fourth quarter of 25. What you'll notice is in 22, when those Mag 7 didn't work, it was because their earnings growth was negative. We've gone through a period since 23 where the only growth in the market was the Mag 7. The yellow, the non-Mag 7, actually had negative earnings. What you're seeing now going forward is a bit of a slowdown in the growth rate, the earnings growth rate of the Mag 7, but a reacceleration of growth in the non-Mag 7. They haven't participated because they had no earnings growth. They're starting to participate now because there's earnings growth there, and they're cheap. So you could see a scenario where you want broader exposure. You want more exposure to the yellow because there's probably a little bit more upside there when you think about market returns going forward. This is not anything we haven't seen before. This chart is a little busy, maybe again hard to read. The top section is looking at the relative performance of equal weight versus cap weight. And all I want to show here is that it moves in cycles. There are periods where an equal weight portfolio that gives you broad exposure to all 500 stocks outperforms, and there are periods where concentration wins. This goes all the way back to 1990. This is a really long time period. Post the tech meltdown, which is where my hair went and the grays came in when I was running growth stock and tech portfolios. People referred to that post-tech wreck period as the lost decade for stocks. It wasn't a lost decade for stocks. It was a lost decade for the largest caps, the techs. If you had an equal weight portfolio, you actually were up 20% during that time period. So there are times to have that broad exposure, and there are times where you want diversification. What we're going to talk about today with free cash flow investing is value investing. And I think a lot of people think value is dead. Value is not dead. There's two things I want to point out with value. There's a time to own it, and make sure your value product is using the right metric to determine the value of a company. That's where the free cash flow conversation is going to come in. Time to own value. This is a chart that goes back to 95. This is the PE of the Russell 1000 growth in the dark black, and then in gray, the PE of the Russell 1000 value. What you'll notice is there are times where growth, right here in 09, was trading at the same value as the value index. Growth was cheap. If I have two stocks with the same PE, but one is growing and one isn't, I'm buying the one that's growing every single time. So it's not that value was dead, it was that growth was cheap. But when you look at where we are now, and these are trailing earnings, the Russell 1000 Growth Index is trading at 38 times. The spread versus value is 1,700 percentage points. This is a pretty wide gap. Growth is expensive right now. Value is cheap. Growth was cheap in the mid-90s. Became expensive. What happened? It got cheaper. This is a time when, value is more attractive. So there's a time when you want exposure to value. Value isn't dead. You just need to know when to own it. Why is value attractive now? We've talked a lot about diversification. It's also a great way to lower risk in your portfolio. We're going to talk about this index. If I could have, I would hide that for right now. But if we just look at value versus core versus growth, the first thing I wanted to point out is beta. The value products are trading at about a 0.7 beta. Growth products about a 1.3. You want to take some systematic market risk out of your portfolio? Buy value. Lower beta. You're going to have, lower drawdowns. You're going to have a little less volatility. And most importantly, you can see that value dispersion, the valuation dispersion. These are forward PEs, but a significant discount. So one way and one thing we always talk about with this product is, lower your portfolio's PE before the market does it for you. This PE is near highs. This is a pretty reasonable valuation. Now, what I will foreshadow and tease is what if you get a value product that not only does well when value is in favor, this is just since the index launched, so this is May of 23 to present, mostly a growth year. Look at how this index has performed. It's keeping up with growth. It's trading at 14 times. It has no Mag 7 exposure. We're going to talk about that, but building a value product using a value factor that is not book value, is not PE, is free cash flow yield. You can build a portfolio that can do well when value does well, but also hold serve, as we'll say, and I'll show you the data, during growth regimes. So this is really the profile of what has driven this to be $1.5 billion ETF in just a year and a half. Again, no Mag 7 exposure. So we're going to get into that, but let's talk about value investing. There are times to own value when the growth PE has a wide spread to value PE, the chart I showed you before. There are times where growth is cheap. The other problem with value and why people think value is dead is we're using antiquated measures to determine the value of a company. Book value, as I'm going to show you in a second, is probably the most common valuation metric in the broad value indexes, the big ones, as I'll show you. But I think all of us from CFA, from business school, ultimately the value of a company is the present value of its future free cash flow. And in today's world, the way the economy has evolved, industries have evolved, book value just doesn't work as well anymore. Here are those indexes, the Russell 1000 value, S&P value, MSCI value, the metrics they use, price to book, price to book, price to book. Fama and French, early 90s, based on the 50 years prior research, when the world was very different. Businesses were hard assets. Today it's technology. Today it's licensing. Today it's patents, it's brand, it's algorithms, software, etc. It's intangible assets. Book value doesn't capture that. As we'll look at, free cash flow yield does. How much better does it perform? Here's a risk-return chart, common valuation metrics. This goes back to 1991, end of 91. Free cash flow yield, upper left corner, 16% return, the lowest risk. PE has low risk, but 400 basis points, 300 plus basis points of excess return for free cash flow yield. Highly effective valuation metric. I touched on this already, just to touch on it a little bit more. Book value is great when you're dealing with industries and companies that have tangible assets, buildings, property, plant, equipment. It undervalues companies that are heavy with patents and IP. Think about Qualcomm. It used to be semiconductors owned their fabs, had to buy all that equipment, had heavy assets. Now they all outsource it. They're a licensing company. I don't want to look at the book value of that company. I need to determine the assets that matter, patents, IP, etc. Just, everybody in this room who's passed the CFA knows what free cash flow is, but it's in the deck, so I'm going to touch on it anyway. Listen, I like to simplify this when I talk to clients or I talk to advisors. What better way is there to measure the quality of a business than one that generates more cash than it needs? In the end of the day, that's what free cash flow is. That tells you it's a great business model. And I think more importantly, I used to be an active manager. I still am in certain products that I oversee. But it tells me management is executing as well. It's the ultimate sign of quality is a company that's generating more cash than it needs. And that cash can either come back to me in dividends, buybacks, or it can go into help the company grow further. So a highly effective measure of the quality of a company. What makes it a value metric is you put it over price. Now I got free cash flow yield. How much am I paying for that dollar of free cash flow? That's what makes it a great value metric, a quality value metric. The Russell 1000 value, you're not getting much of a bargain here versus the core index. It's trading at about the same free cash flow yield. We'll get to this index in just a minute, but to put in perspective, just to take a portfolio of high free cash flow yielding companies and look at it through the lens of PE, and this is our index, it's trading at a 40% discount to the S&P. This is, again, a portfolio that is trading at around 13, 14 times earnings, 40% discount to the S&P. So I was told I had to make this a bit educational, not just a product push. One of the things I would encourage you to always think about when you're looking at an ETF, it's not just the factor. It's the craftsmanship of how you put that factor to work, the methodology you use. How many stocks are in the portfolio? What's the weighting mechanism? How are you determining and measuring free cash flow yield? The art around the factor is the differentiation. We have a team, again, because of our broad perspective of being, responsible for building models, having the ability to use our own home cooking or go out to third party, we have that additional perspective to build products that we think we can't find in the marketplace. And there are other free cash flow products in the market that have done incredibly well, and we're smashing them out of the gate in the first year because of some of the things we did to put some art around taking advantage of this highly effective factor. So what do we do? So I mentioned already, free cash flow yield, free cash flow dollars over price, we'll unpack that in just a second, is giving you that value and quality exposure. What do we do that's different? And we'll take this a little deeper. The art. One is a lot of the free cash flow products in the market are only looking backwards. How much cash flow did the company generate over the prior 12 months? I don't want to pay for past performance. I need to know if that's going to change going forward. So we incorporate a forward look, and we'll talk more about that. The second thing is value traps. Sometimes a company might have an attractive valuation for a reason. If it's not growing, I don't necessarily want it. One of the architects here, when he helped build one of the first free cash flow products at another firm, he referred to this, what we call our growth filter, as his IBM filter. And IBM's done well more recently. There was a long time where it had a great free cash flow yield, but it didn't go anywhere. We want to eliminate those. So we look forward as well as backward on our free cash flow determination measurement, but we also kick out slow growers. So we focus on high-quality companies trading at a discount with favorable growth prospects. Go back to what I showed earlier on. This portfolio up 35%, keeping up with growth, keeping up with core. The growth filter plays an important role in that. So the craftsmanship comes in these last two stages. This is high free cash flow yielders, almost 7%. The Russell 1000 Value Index, the S&P, are less than half that. Trading at a discount, if you looked at it through the lens of PE versus those two same markets with favorable growth prospects, portfolio has sales growth of 10%. How do we do forward looking? How do we measure free cash flow? I told you this is the formula for free cash flow dollars over price. We use enterprise value. We want that balance sheet. We want to penalize companies with a lot of debt, reward those that are leaner. But we take a company's trailing 12 months. This is sort of the industry norm. And we look at the forward estimates. I don't need the forward estimates to be spot on. What I'm looking for are companies that, take a Moderna. I know everybody got the shot. How many people are getting it going forward? I need the inflection points. That's what forward estimates give me, or consensus estimates give me. I own energy. Trailing looks great. Well, CapEx was low for these companies. Oil prices were high. Forward estimates are going to capture the change in trajectory. Suddenly, oil prices have dropped. The industry is starting to drill. Forward estimates give me the inflection points. Help me avoid value traps. The growth filter is really the value trap, but help me make sure I'm not paying for past performance. That's what forward look is meant to do. So we call the combination expected free cash flow. That's what we put over enterprise value. I'm going to get to the right side of the chart, but to put some numbers around it, the S&P 500, this is going back again to January 1st of 92, annualized return 10.3%. If you just focused on trailing free cash flow over enterprise value, just looking backwards, paying for past performance, incredible return, 16%. But just that little bit of an incorporation of forward look, I pick up another 125 basis points. This is our forward look. The second is the growth filter, the IBM filter, the avoiding value traps. It kind of, again, to play to some of our more retail-y clients, we talk a little bit about Warren Buffett's quote. He says this, investors think you look at value and growth in isolation. Great value investor says, no, growth is always part of how I think about valuing a company. That's kind of what the growth filter is. So we find those companies with a great free cash flow yield. I'll go through numbers in a second, how many stocks, but we essentially kick out the bottom third in terms of growth rates. We focus on the higher growth companies. Great free cash flow, no growth, those stocks have only returned 14%. But if I focus on the companies with the greatest trailing and forward with the highest growth rate, now I'm 250 basis points plus ahead of trailing. And again, creating a portfolio that's very durable in growth and value markets. Skip that. Methodology, again, the art, the craftsmanship. What we're showing here are the steps in the process along the top, and then what I want to show you is really these two metrics, the free cash flow yield, where we start, the growth rate, where we start, and then where we end up. So we'll start with the 1,000 largest companies. We'll kick out unprofitable companies. We'll kick out financials, and we're going to kick out real estate. I talked about book value not being great. Free cash flow is not great in those two industries. You have property acquisition and disposals and real estate. You have REITs that are returning income. You have on the banking side just deposits and loans. It just doesn't lend itself to those two industries. So we focus on the largest profitable companies outside of those industries. It gets us about 400 stocks. The free cash flow yield is kind of market-like at 3.5%, but they have decent growth, 12%. The next thing I'm going to do is look at those 400 companies and apply my expected free cash flow over price, free cash flow yield. I take the 75 stocks with the highest free cash flow yield. Now I've doubled almost my free cash flow yield, but I've given up a lot of growth. I bought some of those IBMs, those slow growers. Put it through my growth filter. Focus on the 2/3 fastest growing, 50 stocks. Now I've still doubled the free cash flow yield, but look at my growth rate. Now I'm 9.5%. And then lastly, just weighting those final 50 stocks actually helps enhance my free cash flow yield and my growth rate a bit more. It's simply a function of weighting based on free cash flow yield and dollars. A modified free cash flow yield has helped to enhance that free cash flow yield overall a bit more. The portfolio is 50 stocks. It is loose in its guardrails around sectors. I want to go where the value is in the market. So my sector weights, and we'll talk about this, I can be a maximum of 45%, but really the one that comes into play is no sector can be more than 20% of, say, the Russell 1000 as the starting universe. So it is able to take tracking error. It is able to lean into sectors that are cheap. And we'll touch on that in just a second. So I showed the performance earlier, growth and value markets. Again, a fairly busy slide, but this is the chart to illustrate what I said earlier. A value product that does well in value regimes holds serve in growth markets. All we're doing here is looking at calendar year returns since 2000. If the Russell 1000 value outperformed growth, we painted it green, called it a value year. If the Russell 1000 growth index outperformed the Russell 1000 value, we called it a growth year, painted it blue. What I would want to focus your attention is on the top. And if we start on the columns on the right, in value markets, of course, the Russell 1000 value outperforms the Russell 1000 growth by about 1,000 basis points. But when you flip the script and growth outperforms, suddenly now value is underperforming by 1,000 basis points. This is traditional value. This is value is dead. This is a product that can't withstand the other regime. If you look at our index with the methodology I just described, it does incredibly well in a value market. 16% versus the Russell 1000 value. These are just the average returns of the painted green. But look how it's held serve. It didn't give it all back in a growth market. So we're seeing it in live production. We see it, and this is a rules-based strategy. We can apply it going back. We took it back to 2000. This is outperforming in value, holding serve in a growth market. I mentioned sectors. It will lean in to sectors where it finds stocks that are cheap. You'll notice consumer discretionary, 19%. Energy right now is a big one. We could talk a little bit about the transformation that's gone on in the energy sector, but it has found a lot of value there. It's found value in healthcare. It doesn't own any financials, as I said. Let's talk about what's working in the market right now, year to date. Energy's not been doing very well. Financials have been the best performing sector. We know neither of those, but we're keeping up with the market with no FANG exposure. How are we doing it? Security selection. We're winning because we're finding stocks that are cheap, but still have this great quality dynamic and favorable growth prospects. So take a company like Vistra, energy company that is benefiting from the build out of AI and data centers. They're providing power to data centers. One of the best performing stocks, I think it's outperforming, or it was outperforming NVIDIA. It found AppLovin in September. Have you guys followed AppLovin? The stock's up like 200% since September. It was cheap on a free cash flow basis. Ended up in this portfolio. We take sector bets. It's going to have sector concentration. It's winning on stock selection. As an allocator, as somebody who's using this product in our own multi-asset solution, I see sector concentration and I ask myself 3 questions. Do those sector concentrations complement the rest of my portfolio? Are they the same overweights I have everywhere else? I ask myself, are those sector weights static? Is it always going to be overweight energy? And then I ask myself, am I getting paid for the sector concentration? Am I getting an allocation effect when I look at attribution? The beauty of this product is it's solving all 3. I think most of us would agree we don't own a lot of energy. I showed you the cap weighted. Actually, let me show you some slides. We know those sectors are not big in our cap weighted. Think about your value exposure. Typically, a portfolio is not going to have one value manager. You're going to have 2 or 3 value managers. A lot of bars here, another one that's tough to read. All I'm trying to demonstrate here is that this index, which is this lighter blue color, does not look like other value indexes. I put a high dividend solution in here. The sectors don't look like the high dividend portfolio. The sectors don't look like the Russell 1000 value. I've already demonstrated it doesn't look like a growth portfolio. It doesn't look like a cap weighted. So even though it has these sector concentrations, it's not doubling down on the same sectors I have elsewhere in my portfolio. It's giving me diversification. Are those sector weights static over time? Sand chart. Let's talk about energy. Energy is this navy blue. There are times where it's owned 0, and there's times where it leaned in. When does it lean in? When CapEx is low, when oil prices are high, when these guys aren't spending. When they are, when it's drill, 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 there's no free cash flow. Dumps them. Naked energy. But what's happening in the energy sector right now is there's a lot of great things happening. One is, in terms of productivity enhancement, the sector has had the greatest advancement in productivity of any sector in the S&P right now. They're becoming incredibly efficient, and part of it is that management is now not incentivized based on output, they're based on profitability. They're literally getting paid on the free cash flow they generate. They are not going into massive CapEx cycles. And oil prices have been relatively high. If those conditions change, we'll dump them. But right now, they're generating a lot of free cash flow. Technology is this purple. There are times where we had a lot of technology. Technology has got more, and this goes back, by the way, this is from 1999 to present. So a lot of technology at one point. This is a portfolio. This index actually owned Apple, it owned Microsoft, and it owned NVIDIA. I think I might actually have that on the next slide. I'll jump to it. Owned Microsoft from 2009 to 2017. I want to say it was like a 300% return. It owned Apple from 11 until 19, over 100% return. It owned NVIDIA. It owned Google for a period of time. If they're cheap on a free cash flow over enterprise value, we're going to add it. Find me another value product that's done that. So again, my three things. Is it diversifying the rest of my portfolio? Yes. Are the sectors static? No. It moves around. Let's look at an attribution report. Selection effect, allocation effect. Am I getting a positive benefit from these sectors it leans into? This goes back to 1999. We took the index back here. It's clearly outperformed the Russell 1000 Value Index. A third of that outperformance is coming from an allocation effect, being in the right sectors. So yes, you look at 50 stocks, you look at sector weights, and you say, is this a sector portfolio? But it's diversifying the rest of my holdings. It's not static exposures to sectors, and I'm getting rewarded for it. So where does it fit within a portfolio? Listen, we talked about it being a value replacement. It has multi-factor exposure. So I touched on qual. Free cash flow generation is a quality metric. We find clients using this to increase the quality of their portfolio without adding those common names you find in quality indexes, and I'll show you that in just a second. Some people actually like the sector allocation dynamic that it has, and will use it for that. In terms of that diversification to quality, that's this. This is the MSCI Sector Neutral Quality Index. Look at the top 5 holdings. Here's the weight: 6% in NVIDIA, 5.5% in Apple, almost 5% in Microsoft, 4% plus in Meta. So even my quality index looks like my cap-weighted index. This is the NASDAQ 100. This is the S&P 500. So I can add quality, I can add value, and I'm getting reasonable growth that I can use this portfolio for and source it from all those kinds of positions in my existing portfolio. Get that diversification benefit, lower my portfolio's PE before the market does it for me. This is a great chart, and you just look at, I'll point you to the right, a 50-50 portfolio of one of the most popular growth indexes, the NASDAQ 100, and this index, 50-50, this one goes back to 2007. The 50-50 portfolio, the blue, never goes below zero. It's outperformed the S&P on a rolling 3-year basis 100% of the time. Great pairing, these two portfolios together. This is each of them broken down so you could see why. If growth is underperforming, value is doing well. And if growth is doing well, we're kind of hold and serve. I'm sorry, this is when the NASDAQ is underperforming. But you get the idea, that mirror imaging. They complement each other very well to produce a portfolio that never underperformed the S&P 500. We have the returns, the standard deviation, a pretty high Sharpe ratio. This is where the performance is coming from. Yes, standard deviation is a bit high, but look at the up capture relative to the down capture. A lot of that volatility is upside volatility. Max drawdown, that's better than the overall market. It is going to be high tracking error. When I think about portfolio construction, in the simplest sense, I've got beta, I've got alpha, I've got defense. That's my portfolio construction. This is in my alpha bucket. Beta is my cap-weighted, cheap, passive, and then I have defensive products, whether that be alternatives, whether that be covered call strategies, etc. This is an alpha product. You're going to take that tracking error, but you're getting rewarded for it. Returns, and then just kind of to summarize, and we can open it up to questions again, it is attractively valued companies, high-quality companies, trading at a discount with favorable growth prospects. And again, it's not just about the efficacy of the factor. It's how you put pieces together to build a product that differentiates it from others that just chase the factor return. So I'll stop there. I can talk about anything. If this bored you guys and you don't want to talk about it, I covered a crypto fund for a little while. We could talk about crypto. I covered growth stocks for 25 years. I run a market-neutral alt strategy. So happy to take any questions on really any topics you'd want. We could talk about this, probably why I'm here. So any questions?
Can you just talk about the free cash flow yield metric? How you think about that across various industries? Do you think about it across various industries? Or are you just looking at pure free cash flow yield, not on an industry basis? And then maybe how should we think about kind of guide rails? What is an attractive free cash flow yield?
Yeah.
What's an unattractive free cash flow yield? Are those absolute numbers or those relative numbers based on where we are in a given market segment?
So I'll answer them in the order you asked. I don't care what sector it's in. In the end of the day, I want to buy a company that is cheap. I want to buy a company that's cheap because the present value of its future cash flows is attractive, free cash flow yield. You'll see over time, it moves around. Certain sectors can get cheaper than others. The places where it doesn't work is, financials and real estate. So to your point, when I think about sectors, when we built this, the first thing we said is, it's just not going to work there. Let's not even play in those sectors. But it works everywhere else. It works very well everywhere else. In terms of what's attractive, let's go back to, we can look at this slide. This is the free cash flow yield of the S&P, 3%. This is the Russell 1000 value, 3.7. I take, I think 100 basis points above that would be pretty attractive, but we're giving you 300 plus basis points above that. So this is the weighted average of the portfolio at 7%. We have companies that are probably double digits, down to call it, market-like overall. But a free cash flow yield of about 7% is, again, pretty attractive.
So most quants would use some blend of valuation factors, so price to book, PE, price to cash flow. And the reason is because no one of those is necessarily a priority better, right? Certainly, as you suggest, cash flow has worked best historically. And the reason is partly because they're just different measures of what a company's expected earnings might be. Stock-based compensation is the most obvious example of how to gain free cash flow. So company managers can enrich themselves at the expense of shareholders, and it would never get picked up, right, in free cash flow, but would be picked up in earnings. So my question is, how do you deal with these sorts of issues?
You're 100% right. We have other factor-based products that use composite factors. That is a culmination of a number of different factors. We are using a composite factor for the growth. The growth is actually EBITDA growth, sales trend, and long-term earnings growth. So we're using a composite factor on the growth side. On this product, on the value side, because of its efficacy, because we find free cash flow yield to be so effective, it's a standalone on this. When we have products that want to delve into financials and real estate, we're going to use that other lens of a multi or composite type value metric. In those portfolios, free cash flow yield is a big component of our value factor. But in this solution, to be able to focus just on those industries, we found that to be very effective across these industries as a standalone. But we have a lot of portfolios that do exactly that. Quality metrics that are composite scores, growth metrics, valuation metrics that are... Our framework, if you go all the way back, you guys should meet my partner, Lance. Oh my God, he is one of the smartest human beings I've worked with in 30 years. But when we talk about our active quant, we've built a factor library we call QVM, quality, value, momentum. We have our own factor library, how we calculate each of the kind of valuation metrics, each of the quality metrics, each of the momentum metrics. Again, craftsmanship. A lot of the solutions that lean on our QVM framework are exactly what you're referring to, composite scores of those factors. This is just one where we're not doing it on the value side.
With the free cash flows forward-looking estimates, do you find the data availability is pretty consistent with those forward-looking estimates? Because again, that's just something I think of with, you can always look back on financials, but you're going to be more subject to the analyst community with the estimate portion.
Yeah. It's a great question. We do the same thing in small cap, and the availability becomes a bigger issue there. In the large cap universe, we've got plenty of coverage. We're going to have, in the least covered name, 5 or 6 estimates. In small cap, it gets a little trickier, but it is something we have to be mindful of. But in large cap, we don't have that problem. And again, I don't, first of all, I again, going back to my active days, when I looked at analyst estimates, I threw them in the garbage. I didn't really care about, especially an individual's outlook. The consensus, the sort of group think of the market tended to be more accurate. So as long as I have a sample of consensus that, again, is at least 4 to 5, yeah, it's going to help me at the very least capture those inflection points. One of the things I didn't say is we do rebalance this or reconstitute it quarterly. So again, if estimates change after earnings season, that'll impact that forward look, and we'll capture it. And again, when we think about the value add, it's a subtle but powerful, because it's 100 plus basis points over trailing alone. That doesn't sound like a lot, but it's 100 basis points a year since 91. So it's just that incremental, catch. I gave you the Moderna and the oil example, but anything that's cyclical, it helps us capture those inflection points.
Is it all fundamentally based? Do you guys use any trend and momentum within the strategy to sort out what makes the final portfolio?
No, the final portfolio is going to literally be the 75 companies with the highest free cash flow yield. I'm sorry, the first selection criteria is the 75. The 50 stocks come out of the 75 that also have the highest growth rate. So no, there is no trend in there. The weighting is simply a function, again, of their free cash flow yield, higher free cash flow yield. It's actually the combination of dollars of free cash flow. This is, again, craftsmanship. We want to keep it large cap. One of the ways we accomplish that is we not only weight on free cash flow yield, it's a composite score of free cash flow yield and dollars of free cash flow. Idea being larger companies have more dollars of free cash flow they're going to generate. Just gives us a slight edge in terms of cap, keeps the larger cap names a little bit bigger. Helps to really, yes. That was a big thing, actually, that you bring up. We wanted to stay away from the mid caps where the volatility was higher. Absolutely.
And sorry, one follow-up. So with that, it's purely the free cash flow factor, composite that generates the weights, and then you can go to your prior chart showed you can go 0 in the sector. Yep. Hypothetically, you can go, up to 100% in the sector.
No, it's capped at 20% above the starting index, which is basically the Russell 1000. So you can never go above. It's a 45% absolute cap, which would be technology, or 20% above starting universe. So guardrails, but very loose guardrails. But any of these ETFs you buy that call themselves rules-based, there's no human intervention. And this is good for you guys because, I used to be an active manager, and you get emotional and you want to say, why is it buying AppLovin? What is this company? You let the rules play out, because building rules-based portfolios are, I always make the analogy, it's kind of like being at the blackjack table. You have to play by the house rules to get those great odds, the best odds in Vegas. The moment you hit when you're not supposed to, you blew those odds. Leaving the world of active and going to highly systematic, if not rules-based strategies, has been very refreshing for me, because you take that emotion out and you play to the probability, the batting average, the success rate of a solution that I've been able to backtest through various market cycles, various environments. This is a strategy with a very high batting average. Our market neutral income alt strategy, highly systematic and incredible batting average. But there are other solutions, high dividend, even, we have, I don't want to go through down the line, but there are other strategies that work in the regimes they're supposed to, and they're not going to work in the regimes they're not supposed to. This is one that fits in that more durable through various market cycles kind of a solution. He raised it first.
Y'all have been pretty hard into energy the last couple of years, given, I guess, the free cash flow yield, the capital discipline, shareholder returns. Are y'all still pretty optimistic about that going forward?
So, again, this is where I kind of come back to my fundamental hat. I've lived through a lot of transformations in industries. I touched on semiconductors going to fab light. I was an active manager covering tech for 25 years. I watched them outsource their manufacturing, changed those stocks. They didn't have that incredible cyclicality of like double ordering, overbuilding to the trailing demand, and then all of a sudden get stuck with it when demand falls off a cliff. I watched software go to downloadable cloud-based delivery as opposed to sending disks out and having IT teams have to install it. Energy's going through one of those transformations right now. The technology that's going into drilling these wells is unbelievable, and they're able to now drive so much more productivity per dollar spent, reduce labor costs. There was a great article, if anybody wants it, email me after this, talking about how this sector has had more productivity improvements, enhancements, than even the tech sector in the last decade. It has been a transformation. The market's not capturing that yet because the market is worried about the macro stuff, the demand, policy, regulation. These stocks have discounted all of that. That's what this product is telling you, is that it has discounted those elements. What it's not capturing yet is these companies are spitting off cash. The managements of these companies will tell you they're profitable at $40 oil. It is an industry that has gone through a transformation. This product is picking that up. And right now, they're not really getting rewarded for it, but this is still first percentile in the Russell 1000 value peer group, despite having a 20% energy exposure. So it's a great question, and it's a great industry to really, I think, if I were an active manager, I'd be spending a lot of time looking at it. Because I guess the other big transformation is these management teams, as I said earlier, their incentive comp used to be based on exploration and discovery. How many barrels could you find in the ground? It isn't that anymore. It's based on literally free cash flow. Chevron, a week ago, cut their CapEx expense to boost their free cash flow. Do you know why? Because that's how they get paid. They're going to do the things that treat them best. And it's been a transformation on the way they're compensated, and they're putting their money where their mouth is. It's a great question. It's a really interesting industry that I'm spending more time trying to.
So is the ETF more towards the exploration production versus refiners, or is it?
Yeah, right now, it is like Chevron is one of the biggest holdings. I don't have all the holdings on here, but it's more E&P than refiners.
So the shortest you would hold a company would be 1 quarter, since you're quarterly. And you showed some hypothetical in the past of how long you'd own capital.
Yep.
Have you looked at how long you typically own?
The portfolio has, turnover is by design. What does my partner always say? It's a feature, not a bug. It's over 100% for a reason. AppLovin is out of this portfolio in the middle of December, in a week when we reconstitute. Stock's up 200%. The free cash flow yield shrunk. We've been in and out of Expedia over the last year because it's had quarters where it pops 10%, and then it gives back 10%. We buy back. We've, I think, been in and out of that or changed the weight 3 times. Vistra is a company that we will trim. What we ultimately love about this portfolio is every time it reconstitutes, that multiple right now currently is about 14.6. When it reconstitutes in 2 weeks, it's probably going to be 12 or 13. We're going to kick out all those stocks that appreciated. Free cash flow yield came down. We're going to go to the next cheapest companies. So there are plenty of companies we hold for 3 months. But I don't know what the average holding period is. It's a good question. My partner may know the actual answer to that, but the portfolio's turnover is north of 100%, about 100%. I don't care either, because the other thing about it being a feature, not a bug, is it's in an ETF. There's no capital gains. So it's a beautiful thing to be able to churn it, get cheaper, sell here, buy here. Essentially what a good value shop should do, a good value product should do. I can follow up and get that answer. It's actually a good question. I don't know the average holding period. Crypto? Yeah, to the moon.
You used to do it, so.
Yeah.
Well, on financial stocks, so there's financial companies like traditional banks and insurance, but like consumer finance companies where EBITDA is still a useful measure. Those be included in these types of analysis or still excluded?
The rules-based, to keep it simple and not have a discretionary lens to kick them out and determine which it is, anything that is classified in GICS as a financial is going to get booted. Visa used to be a tech name. I don't know what it is anymore. I don't know. I think it can own Visa. I forget what it is now. I haven't been inactive for 8 years now. But it could, if it falls in there, it'll own it. Yep. Awesome. Well, absolutely. Thank you.